Travillian Next is a division of Travillian, a financial services specialist search and talent advisory firm. Since inception, the Travillian team has dedicated itself to enhancing the return on investment of a company's most important resource, its people.
Hello, everyone. I'm Brian Love, head of banking and fintech. Alongside of me is Indra Elangovan, business development executive here at Travillian. And we are joined with Hernan Hernandez, Director of Investment Banking at Credit Suisse. How are you, Hernan?
Doing very well, thank you, and thanks for having me.
You bet. How are you, Indra?
Fine, thank you.
Terrific. The topic today is on everyone's mind. The last 48 hours, actually the last several calendar days, has seen the entire banking sector with pits in their bellies about the failures of Silicon Valley Bank and Signature Bank. And we wanted to pick Hernan's mind around these particular subjects. Hernan, could you give us a quick overview of your background? It's very unique, and that's why we were excited to get your perspective.
Yeah, sure, no problem. Yeah, so I've been in the banking industry for about 35 years now. Really started in college as a bank teller, so you kind of get down to the nuts and bolts. And I graduated in '90, right during that recession, and I got an offer from the FDIC. And there we're kind of at the tail end of the S&L crisis, but still a lot of banks were failing. And and got to put some bad guys behind bars with working with FBI white collar, and it was a really interesting time. I was there about 7 years, and then went into the private sector working for about a $6 billion bank called Imperial Bank in LA, and that got sold to Comerica. And then from Comerica, I went to City National Bank, which was about 12 billion, and it grew to about 90 billion along there, a sale to RBC, which is about $1 trillion plus dollar company in Canada. And from there, I decided to broaden my my audience by I was working in-house corp dev, mostly in these past banks, and now I decided to take my talents to a broader audience in investment banking.
Hernan, what do you think happened over the past weekend, given the fallout of SVB Bank?
Yeah, it's a good question. It was very much a surprise for all of us, the industry, the regulators. We've never seen banks fail this quickly and fast and furious of deposits leaving banks. I think what we learned from the last two recessions, where a lot of the regulations were around the asset side, the lending side, and to be careful there. Make sure you have plenty of capital against riskier loans like construction, credit cards, etc. But the regulations over the past 20, 30 years focus very little on the deposit side. And we have, as you can see here with Silicon Valley Bank, we allowed a relatively small bank compared to the money center banks to have a pretty high concentration in very, very large deposits and with sizable clients. And to the point to where I believe around 90 or maybe 90+% of the deposits were uninsured, and it only needed a few of those depositors to leave to cause a liquidity crunch where they had inability to sell securities that were underwater because they bought these securities back when rates were much lower, and that just wiped out their capital. Unable to raise capital, they had a failed auction back in, I think, at the beginning of Friday or Thursday. And so that caused, in my opinion, this failure of a blue chip bank, for sure.
And Hernan, just to jump in, earlier in the week, Silvergate, a much smaller bank, announced it's winding down. It was a failure, but it was almost manually winding down, right? And then, not to jump too far, but over the weekend, we see Signature Bank on the other coast here in New York, on the East Coast, fails as well. Basically, the government just stepped in over a weekend, which is just crazy to me that a bank fails on a weekend. And can you tell me some thoughts about that?
Yeah, sure. Going back to Silvergate, I mean, it was a relatively very small bank, but it was very concentrated in the crypto space.
Yeah,
they actually had arguably, even though its size was much smaller, it had probably a more robust asset liability model, because they were actually able to liquidate, take about a 90% decline in deposits and still keep the liquidity out there. Sure, it wiped out their capital and a bunch of other stuff, but at the end of the day, they survived. They just decided to voluntarily hand the keys back and say, all right, we're done with this. Which actually was a really good, whoever worked with them on their asset liability model did a great job. Going back to Signature Bank, and it goes, this is the first time ever a bank failed on a Sunday. How could a bank fail on a Sunday? And the reason
It's
for
the
that,
Lord's Day, you know.
yeah.
Sorry.
And the reason for that is they had this differentiated product called Signet, I believe it was called.
That's correct.
Where you can
Yeah.
move monies 24/7, 365. And you don't have to worry, you don't have to deal with the Fed wires and this and that. Well, guess what happened? The demise of this bank, I believe, if they weren't able to do that, and if you think about it, about an hour or two after they failed, the regulators came in, hey, we're going to support all deposits for all the Silicon Valley Bank and now Signature Bank, because it failed 2 hours earlier. So so they had this sophisticated system that, I don't know if it worked against them, but maybe they would have had the same run on Monday. But that's why it failed on a Sunday. Yeah, it's a very interesting model. There they had a lot of crypto deposits too at Signature Bank. They were winding that down, but not fast enough. And then that combined with other jitters from the Silicon Valley Bank failure, they just had another run on that bank.
Yeah,
So these failures are happening because on the liability side, the deposit side, the deposits are running out, not enough cash to get the monies out. The regulators had to step in to stop the bleeding, to keep the remnants afloat, so everyone take a breather. On Sunday, we're gonna, hey, everything's gonna be insured here. I know that's our policy was 250, but now we're gonna step up and insure them all. Everyone relax. We're gonna open up the doors on Monday and see how the rest of these other regional banks fared. We saw the stock get hammered at First Republic, at Western Alliance, PacWest, and from what I've read, I don't think any of those have failed or have been closed. So hopefully it'll just be a market hit on the stock.
And on Silicon Valley, from what I hear, they're still trying to basically be acquired.
Yeah.
Even as of tonight, which right now it's Monday night at 5:30 p.m. What should the FDIC do, and what was missed?
Yeah, I think what was missed is when you have a deposit run. Going back to the 09-08 recession, which is still kind of fresh in people's minds, that recession was being those bank failures were happening because you keep writing down the value of construction loans, of mortgages and this and that took a while for that to kind of shrink down. So the FDIC had time to park examiners, in the bank and see, okay, you got to mark this from 100 cents to 80 cents, from 80 cents to 60 cents. When it hits 50, we're gonna shut the doors and we're gonna bring in a new buyer. And while it was in that range, they created data rooms. Banks like City National, we bid on, I think, 8 or 9 failed banks and won 4 of those auctions. So you had time to kind of go through and see, what you're bidding on. And in this particular case, it had to get shut down. Now they had to create this bridge bank, and now they got to figure out what's left over. And then the FDIC here has to set up the same data rooms and everything that I went through, 10, 12 years ago. Have to do the same thing again, but it has to happen in a short window, in a few days, versus what, we had probably a few weeks back in 10, 12 years ago. So, I believe there is going to be, I know the CEO and the CFO of Silicon Valley Bank, and good bankers. I think their mistake was they brought on too many of these deposits were sitting off balance sheet in a fund that they had. And then they were yielding probably 20 basis points, or flipping 15 basis points to the client. They were keeping 5 basis points, and they go, I have a great idea. We'll just bring them on balance sheet. They're going to be around forever. We'll just put the money into 2% treasuries or mortgage-backed securities, and boy, we'll keep 185 basis points instead of only 5. Well, that works well until rates go up. The tech industry has to shrink because of its issues it's going through, and boom, now you got to run. But at the end of the day, at Silicon Valley Bank, the loans are good. They're paying as agreed. They only had 8 basis points of NPAs. After this $40 billion run off of deposits, they still have a 50-60% loan to deposit ratio. The securities that are left over are good securities. It just had to be marked to market, right? They're just coming down. So personally, I believe the bidder, it will have a relatively easy time bidding on Silicon Valley Bank. It's big. You're going to have a lot of capital to take it over, because it'll probably at the end of the day still be around 150, $160 billion in size. But I mean, I think if you keep the business model together, if you keep the clients engaged and all the relationship managers around, say, okay, now we're owned by whoever, pick a name, and say, okay, now let's get back to work, and let's get back and servicing our clients, and we're going to continue doing this, and this. And I think the winner of this bank is probably going to make quite a bit of money, to be honest.
Wow.
And there might be even some money left over to return to the shareholders, based on my quick math. But now that it's been shut down by the FDIC, now the company's gone. I don't know how that really works. I doubt the FDIC will keep the money if there's over and above what was left over.
But just off of what, just 2 quick questions off of what you said. Just to play a little conjecture game, who winds up buying Silicon Valley Bank? It's really a very small grouping of banks that could afford it. Yeah. And by the time this airs, we might already have an answer. There. And then second question is, 2008, after the collapse, they upped the insurance level to 250. Mm-hmm. I mean, it was 100 before that, from 1980 to 2008. Yeah. Everyone thinks it's been 250 for forever. It's only been, 15 years. Does this go up to 500? Maybe you think the FDIC, considering, how far the dollar even goes these days. So those 2 questions, I just wonder, maybe some quick responses.
Yeah, there. Great questions. Yeah, I think, I was over the weekend, I was working with some potential buyers. I was making some calls starting Friday to see if we can get, what we want to do is have a fair auction. Mm-hmm. To not just to protect the FDIC's fund, but also, the shareholders and the unsecured debt holders as well, right? Preferred shareholders. So to get a fair auction, you want to get as many, large enough, stable, good banks to bid on this. And obviously, the one that comes to mind is JP Morgan. It's a great bank. Diversified. They already do some technology lending. They compete with Silicon Valley Bank. That's probably going to be a logical buyer. But I could see my old employer RBC. They decided not to. I believe I read that this morning. But I tried to get them to bid on it. But it's harder for a foreign bank to take over a $200 billion or $200 billion bank. Because you need to get capital into the United States. That takes a little bit of time, and you have to route that through a foreign bank holding company. I think the Canadian banks would have been great buyers for this asset, but I also can see, it's probably, given the speed and how fast it needs to be sold, it'll probably go to one of the money center banks. Yeah, I think it's still a little bit too big for, say, a PNC or a Truist to. Yeah, that's a big percentage of their total assets right now. So probably, depending how much their excess capital is in liquidity, because it's very difficult for, let's say, a PNC to say, okay, I want it, but I need to go raise some capital. Like right now, it's like impossible to raise capital, and you'll get slaughtered, right? If so it's tough. Yeah, Silicon Valley Bank tried and they couldn't do it. So it has to be a big enough company that probably doesn't have to go through all that.
Okay. And then the other question about the deposit insurance, do you think that the FDIC changes that perhaps because of this?
Yeah, if it was, so I have a close colleague or a friend now that we were colleagues. We actually started the FDIC together. So we were on the phone all weekend and wondering, well, what should we do here? And so we kind of had this theory to where you should really have like 2 funds, right? You want to have like a consumer fund where the 250 might be enough. but then you might want to have this other unsecured deposit fund, which is now unsecured, which will be more, I guess, more of a corporate or business account fund. So I have the stats in front of me here. I pulled them over the weekend. And in 2002, we had $5 trillion in the system. 3.5 trillion was insured. And so 1.5 trillion uninsured. And you had 8,000 commercial banks to spread it around. Fast forward 2022, after COVID, we got pumped a bunch of liquidity into the system. Now we got $18 trillion in the system. Only 10 trillion, excuse me, is insured. That leaves 8 trillion uninsured. And so that's 43% of total deposits are now uninsured versus 30% way back in 2000. So you got a lot more uninsured than insured now. So, and there's only 4,100 banks around, and probably only maybe 500 of those can handle large corporate accounts, right? Because it takes pretty complex cash management systems to do that. So I'm thinking probably a system where you kind of have two funds just to build the thing up. And if you have, I'll call it a tiered system based on the size of your deposits versus as a percentage of your total deposits or percentage of capital, that might be a way of creating a tiered system of charging banks that have these larger deposits to basically have two funds, for lack of a better term. So it's less so more, in my opinion, raising from 250 to 500. That's not going to do much good at all, especially when you have Apple or Roku that have 500 million in there. It doesn't really move the needle. So you need to have kind of a system like that. Now there's a way of building. So right now there's about $128 billion in the fund, which is like nothing, right?
Yeah, right.
It's only 0.72% of total deposits out in the system. So what happened in 09, 08, and 2010, I think it was 2010, 2011, around there, I think it was 2010, where the FDIC ran out of cash. Actually, the fund went negative. Very few people know this, but in 2009, I believe the fund went negative. Yeah. And so it was negative for 2010 and 2009. So what the FDIC did is like, all right, we need cash like now. So they told all the banks to pay, I think it was 2 or 3 years worth of assessments. Send it to me right now. Don't worry, it's not going to hit your P&L. You just get to amortize. It's like a prepaid expense. You get to amortize that out. So there's a way to actually filling the coffers up and working with the accounting to make sure that it doesn't really hit everybody's P&L right now. That way you can get deposits, get that fund built up. There'll be no more questions. Okay, all deposits are going to be insured, but here's the new program. And if you want to get these big deposits on your, no problem, but you just have to pay a higher premium. And let's get going. And let's make sure the US has the biggest and best, safest banking system in the world. We almost lost control of it again over the weekend. That's what we cannot have that happen. We see the ripple effects all around Europe now and Asia. I mean, it's just lucky it's not that bad, but it's we just can't. We are the world's central bank, right? We can't lose control of that. We can't lose control of the confidence in the system. And I believe by making a few good changes, we could have a pretty, we just create even more confidence around the system, because it's a good system. And the loss share program works fine. I think, we'll find a buyer for Silicon Valley Bank. We'll find a buyer for Signature Bank. Like I mentioned, we bid on 9, I believe, failed banks. We won 4 of them. It was relatively seamless. We kept as many of the employees as we could. We kept as many of the clients as we could. A lot of them are still working at City National that came from these failed institutions. And I suspect the same will happen with Silicon Valley Bank and Signature Bank. These are good people, great talent. Yeah. Silicon Valley Bank had some fantastic investment bankers, fantastic fund managers, really good relationship managers. They really understand, really good credit. You just don't want that to go away. And with the loss share program, and for this transition over to whoever the new buyer is, could work really, really well.
Okay. Indra, do you want to hop in with a question of your own?
Yeah. So given the swift failure of Silicon Valley Bank, obviously it is clearly not a solvency issue, it's a liquidity issue. So how do you think regulators will look at the liquidity rules in your view?
Yeah, that's a good question. I think the steps that were taken over the weekend are good ones, where you can kind of create these borrowing lines from the Fed up to a year, I think it was. And so we just need to have it. That's the right thing to do, is borrow when you can, so you can buy yourself a little time till things calm down and sort it out. That program, I think, is a great program, because what happened was we've been in a low rate environment effectively for 20 plus years, right? So when so much deposits enters the system, as I mentioned earlier, and you can't lend it out as fast, you have to buy securities with it. And when rates go up, the securities are going to be underwater, and you can't sell them without wiping out your capital. So you can't really create regulation that says, well, if your capital goes to zero because of rate marks, you're okay. You know, we can't really do that. So the only other option is to kind of, okay, don't leave those securities there, don't sell them, and go borrow over here. And that's effectively what, First Republic kind of said over on their press release over the weekend. It says, hey, we got all these we can borrow from the Federal Home Loan Bank, borrow from the Fed. Oh, they have yet another line from JP Morgan. And look, we're not going to fail here, right? So the problem is, what are those? Their margin is only 2%. So the loan or the rate on those borrowings might be 5-6%. So their margin is going to get squeezed. But you get to live another day and really kind of work on right, creating better models around asset liability management. So I think the regulators are going to be a lot more. There's in the CAMELS rating system for a bank, as you know, the S is for sensitivity, rate sensitivity. The regulators haven't focused too much on that S. Well, now that S is going to be the biggie, right? So now they're going to go, okay, let's take a look at your asset liability system. Let's test this, let's test that. And really it's, we found that a lot of banks were relying on historical betas, as you know, as an analyst, my last time the rates went up, my beta was 20-30%. So now I think it might be 30-35%. Well, a lot of those have been blown out of the water. They're going 150%, or they just leave, right? That's even worse. And that's what happened at Silicon Valley Bank and Signature Bank. So it didn't matter what rate you were going to give them, they weren't going to stay, right? They're just, I'm out.
Right.
So I think there's going to be a much stricter, tougher stress testing in and around asset liability management. Yeah, in those models.
Perfect. Yeah. And then could you please take us through the bidding process that you've been working currently?
Yeah, so typically what happens when a bank fails, the FDIC does what it does. It steps in, puts the padlock on the doors. All right, let's freeze everything and see what we have here. See what we have, and see what are the assets and liabilities. What do we have on the table here as of now? So they kind of go through and see, and then based on all the deposits that left and the securities that had to be sold and at a loss, and they kind of try to figure out, all right, what's your assets and what's your liabilities? And they forget about capital. They just say which one is, doesn't matter if one's bigger than the other, is just say, okay, here's the assets, here's the liabilities, what's your bid? And from there, you could, if there's a hole in the balance sheet, just say, well, FDIC, I'll offer a negative $1 billion to take the whole thing over, or negative $2 billion, or negative $5 billion. And sometimes you bid extra negative to get a little bit of money coming in from the FDIC, so that can kind of cover any kind of mistakes you might have in evaluating the assets and the liabilities, if that makes sense. So it's a pretty simple process. They only really have two numbers you put in to the bid: your negative, or your bid on the assets, net assets, and then the deposit premium. That's it. Only those two numbers. Out of that, you have to work backwards to see how what the ultimate balance sheet will be after you take it over. And in the case of in 2009, 10, 11, around there, you had a deposit, you had a FDIC receivable or a guarantee on certain assets, typically with the loans and other real estate owned. In a case like in Silicon Valley Bank, the loans were about, I forgot, around 70 billion, 75 billion, but they were good loans. They were paying as agreed. So, the mark on those loans, the credit mark on those loans is probably pretty small. So the FDIC guarantee is probably going to be pretty small.
Mhm.
So it should be a pretty fast process. It should be, in my opinion, it should have a good outcome for the buyer, the FDIC, and hopefully have return some of the money to the shareholders and unsecured debt holders. Thank you.
Right. Thank you.
I guess I'm just trying to think. BMO paid what, about 14 billion for Bank of the West, which again, I think Bank of the West was only 100 billion in assets.
Yeah.
So we're looking at a price tag on this deal to be 20 billion ish. Is that correct?
It probably not, because I think based on my math, let's say the equity got wiped out. So your assets and your liabilities, let's say, are about the same. However, so it made, I have my notes here. So it made about 2.2 billion pre-tax in 2022. How much do we think this remnants of this will be making in 2023 and beyond? And how much of it, like I mentioned earlier, can you keep the clients and the colleagues together? Let's say it makes half of that. And if it makes half, let's say $1 billion pre-tax, call it 600 million after tax, what multiple would you put on there? Let's say 5 times, 3 times, 10 times, depends on how aggressive you want to be. But if there was no hole in the balance sheet, meaning the assets and liabilities equaled each other, and I could see maybe a $3, $4, $5 billion bid for this organization, if not more. And that could be returned back to shareholders, pay off your unsecured debt holders. The FDIC is out and say no risk to the fund, and then onward to Signature Bank, or anybody else. So I think it's now there's less. There's more clarity on the asset side. These are good securities, just had to be marked to market, and the loans are paying as agreed. I would suspect it'll be a similar situation at Signature Bank. So it'd be surprising if somebody bids up that high, as you mentioned earlier, but keep in mind, Signature Bank had a $40 billion market cap a year and a half ago. So it's amazing what happens, and it's hopefully we get some return to the shareholders.
Well, with that, Hernan, I want to just thank you. Obviously, feel like there's a few innings ahead of us.
Yes.
In this whole story. I think, with any luck, the worst is behind us, and the government did step in and, really tighten the screws to make sure this wasn't a pandemic of sorts. But I can't thank you enough for your perspective, your time with the FDIC and helping at City National, really kind of dovetails right into a unique outlook for what both of those banks are going through right now. So thanks so much for joining us. Greatly appreciated. And also, Indra, thank you for joining us as well.
Thank you.
Thanks again. All right, take care.